Well, hi everyone. Thanks a lot for joining. I'm Dan, CTO of Comply First, and I'll be moderating today. Fiona is going to provide a 30-minute snapshot today on the major regulatory and tax reporting requirements landing in the UK in 2026. She will walk you through 3 new reporting requirements that will hit payment, e-money, and crypto firms this year. Firstly, the FCA's monthly Safeguarding Return, CRS2 reporting, and then lastly, CARF reporting. A quick note before we start, this webinar is for general information only. It is not legal or tax advice, so please double check with your legal team before relying on anything that we cover. We'll be sharing all of the slides and the webinar recording at the end. We've also left some time for Q&A, so if you've got any questions, drop them in the chat and we'll handle them at the end of the webinar. So to introduce our CEO, Fiona, who's running today's webinar. She brings over 12 years of compliance experience from Goldman, Citi, and a fintech. She's a barrister in England and Wales, a certified AML specialist, and now solely focused on keeping up with new reporting requirements and helping compliance teams translate them into actual submissions. Over to you, Fiona.
Yeah, great. Thank you so much, Dan. I guess before we start in earnest into today's session, I want to flag what we'll be covering. So we will be covering the FCA monthly safeguarding return, CRS2 and CARF reporting. And our goal with these 3 reports is to help you understand the scope of each of them, clarify the key data inputs that you need to collect to report properly, and outline the next steps that you need to take to get ready for submission. And so here's a quick timeline view of what's coming up for UK reporting teams this year. It's a fairly busy year. You've got 3 new major reporting requirements on the horizon. So the FCA new monthly safeguarding return, the first submission is due on the 19th of June this year. And CRS2 and the CARF reporting requirements, the requirements to collect data are live now. They were live from the 1st of January this year, with submission due for both of those in May 2027 next year. So although the safeguarding return is the immediate lift and it's a monthly frequency from May, and the other 2 are annual, they still require data capture and controls starting now, not next year. So they're very much a now problem. So before we get into each of these returns, I just want to run a quick poll just to see how you're all feeling for these 2026-2027 UK reporting changes, where they are applicable to you. So if we could open up for a poll now. So yes, how do you feel? Do you feel like you're right on track? You've scoped it out, you're all on time and on track? Or are things in progress, but there are gaps that remain? Or are you behind and you're still figuring it out? Let us know. We're going to take 10 seconds for a quick vote. Okay, I believe we're sharing the results there. So most of us are in progress. We've started, but there are some gaps remain, which is completely fair enough. So that's where we'll focus our efforts. And it's probably interesting for you to know as well how your peers are feeling too. So with that in mind, let's start with the FCA monthly safeguarding return. It's the one that's right around the corner. Before we zoom into the actual return itself, though, I think it's worth spending just a minute on the bigger safeguarding picture and the changes that are happening at the minute. Because this new safeguarding report isn't happening solely in a vacuum. There are other broader changes happening. So there's a new safeguarding regime that goes live on the 7th of May, and it's basically the biggest overhaul of safeguarding rules since the payment services regulations and e-money regulations first came into force. And these changes are being driven by some fairly high-profile firm failures that we've seen in the past. So the likes of Ipigo in 2019, which exposed issues like poor record keeping, years of delays for customers trying to get their funds back, and customers recovering less than half of their funds. So the FCA is actively trying to close these gaps, and the direction is definitely tighter controls, more evidence needed, and more frequent reporting. So at a high level, the FCA is trying to tighten safeguarding across 5 key areas. I'm just going to highlight these now. So first is daily reconciliations. So the FCA are expecting reconciliations at least once on each reconciliation day rather than each business day. So that will be helpful for larger firms with sort of complex business models and different business days across different geographies. You'll define the reconciliation days. And what you need to do on those reconciliation days is compare your safeguarding requirement versus your safeguarding resource. So that's the amount that you should be holding versus the amount actually sitting in your accounts. And we'll discuss how you properly calculate that in just a minute. Second up is resolution packs. So the FCA are sticking to their requirement that resolution packs are essential. They must be a living, breathing document showing all your safeguarding accounts, your custodians, your list of any agents and distributors if you have them, and step-by-step procedures for returning funds to customers along with copies of your safeguarding contracts. The third thing on the list is annual safeguarding audits. So these must be completed by most firms now, unless you're a firm that is safeguarding less than £100,000 over the past 53 weeks. The auditor must be qualified and have safeguarding experience. The fourth thing on the list is the FCA is expecting stronger third-party oversight by firms. So they're expecting firms to better manage who holds their safeguarded funds, so the likes of banks and insurers or guarantors. And they're also expecting you to have documented decisions and plans in place for when things happen like insurances or guarantees lapse. They're expecting you to have built-in decisions ready to go and be able to act quickly. And the last thing on the list, which is what we're all here today to discuss, is the new monthly safeguarding return. So all firms must submit a new monthly safeguarding return to the FCA, and we're going to zoom in on exactly what this return is asking us for now. So the real objective with this return is to ensure that the FCA receives regular and comprehensive information about a firm's safeguarding of relevant funds. And at a high level, this return covers your safeguarding method, balances, the institutions where you're holding your safeguarding funds, your safeguarding resource versus requirements, reconciliations, record keeping, and any notifiable breaches. And the big question that firms always ask, does this report apply to me? Well, yes, it applies to all safeguarding institutions. That includes authorized payment institutions, electronic money institutions, and small payment institutions and small EMIs where they have opted into safeguarding. And the what you need to report bit, this is any relevant funds that you're required to safeguard under the payment service regulations or the e-money regulations. In terms of submission, the return needs to be submitted within 15 days after month end to the FCA via their reg data platform. The first month is May 2026, so 15 business days after month end would be 19th of June, so mark that date in your diaries. Now, there's one sort of key consideration with this return, and that is namely that the various sections are conditional. So, for example, sections 1, 2, and 9 will apply to all firms. Sections 3 and 8 apply to you only if you were required to safeguard during the period, and sections 10 to 17 only apply for unrelated payment services. So, for example, if you're an EMI providing payment services unrelated to your e-money issuance, or you're a small EMI who opted in, or a credit union who opted in, that's when you need to complete those sections. And now just on to the various data points that you'll need to collect. So if you were required to safeguard during the period, which I assume most of you will be on this call, then sections 1 to 9 apply. And I'm going to run through very quickly what these sections require now. So section 9 is your basic setup. So your firm name, the type of safeguarding institution that you are, and details on your last safeguarding audit. Section 2 is all around your safeguarding method. So if you were in scope for safeguarding, what method did you use? Were you using segregation, insurance or guarantee, or maybe some combination? The number of clients that you safeguarded for during that period, and any use of non-standard internal reconciliation procedures during that period. The third section is fairly simple. That's your balances. So that's simply your highest and lowest safeguarding requirement during the period. Fourth is all about where you're holding those funds. So if you're using the segregation method, who is the credit institution where funds are held with, the type of account, the number of accounts, and the total amounts held in those accounts, and also the country of that credit institution. And the FCA is also keen to know, is the contract a fixed term contract, or is there a notice period component to the contract? For insurers or guarantors, you need to record the name of the insurer or guarantor, the amount covered, the date of expiry, and any total overdue premiums. And lastly, under that section, where you've invested in secure liquid assets, you need to record the asset type, the name of the custodian, and the total value of assets held at the end of the reporting period. So fifth section is your resource versus your safeguarding requirement. So that's where you report what you've actually safeguarded across all of your various bank accounts, your segregated funds not yet placed, and any relevant assets and insurance or guarantees that you have in place. You then compare that to what you should be safeguarding, and that includes any amounts received but you've not yet allocated to an individual client account. And then you work out the difference between the two. So you work out whether you've had an excess or a shortfall at month end, and then you need to disclose what you've done to fix that excess or shortfall. Section 6 is the D+1, day plus one segregation check. So that's where you report your safeguarding requirement versus safeguarding resource from your last internal reconciliation that you did, along with any adjustments that you made. Section 7 on reconciliations is about whether you carried out internal reconciliations using your own books and records on every reconciliation day, and did you also carry out external reconciliations using external evidence like bank statements, for example, on every reconciliation day. So you just need to let them know that you did that. Section 8 is all around record keeping. So think of this as your inventory of all of your safeguarding accounts and assets. So they will want to know how many accounts you had at the start of the month, how many you opened during the month, how many you closed, and how many you had at the end of the month. Then you confirm how many of those accounts are covered by an acknowledgement letter, and if any letters are missing, then explain why. The last section is around notifiable breaches. So this is where the FCA is basically asking you, did anything happen during the month that you should have notified us about under CAS? So for example, were there material errors in your records? So were your records materially out of date, inaccurate, or invalid? Were any reconciliations failed? So were you unable to perform the required internal or external reconciliation for some reason? Were there any unresolved discrepancies? So you performed the reconciliation, but you weren't able to fix shortfalls or excesses? And material shortfalls. So is there a material difference between your safeguarding requirement or resource? Then you should let them know. The last two notifiable breaches are around insurance policies and guarantees. So if they're about to expire and you don't have a replacement lined up, you need to tell the FCA 3 months in advance. And lastly, was there any other breach of duty under CAS 15 that the FCA should know about? Then you need to record it here. And so for any firms providing unrelated payment services, which we discussed just a minute ago, so for example, you're an e-money firm providing a payment service unrelated to the issuance of e-money, then you will complete the same checks that we've just described for sections 10 to 17. So in terms of next steps and how you get ready for this return, first up, you need to determine scope. Are you required to safeguard? Did you opt in, for instance? And do you need to complete sections 10 to 17 based on your business model? Figure out those points up front. Second is figure out, can you automate this return or streamline it in some way? You'll be doing it every month, so a canned extract is going to be really essential. And lastly, diarize the submission dates. They're due 15 business days at the end of each month, so get them in your calendars now. Next up, we're going to move on to a snapshot of the Common Reporting Standard 2. So this one is annual, but it's important to treat as a now problem because 2026 is the year that you collect all of this data and you'll report it next year. So the timeline is from the 1st of January this year, you needed to start collecting the right data, and in 2027, you'll report what you collected. So what is the goal with CRS2? Well, basically, it's the next step in global tax transparency. And the whole goal is to ensure that financial institutions report relevant financial accounts with complete tax residency data so that tax authorities can exchange this data internationally if they need to. And the key change for payment and e-money teams is this. This used to be a bank-style only report, but recently e-money and digital products are now newly in scope, and that means PIs and EMIs will need to treat CRS as potentially a core reporting requirement. So what does CRS2 require in practice? So at its core, CRS is an annual return where you need to do three things. You need to, first of all, capture and validate customer tax residency at onboarding. 2, you need to monitor for any changes in circumstance over time that might trigger you to ask their customer about their tax residency. And 3, you need to file all of that reportable account data at the end of each year to HMRC. So the big question is always, are you in scope? Well, banks, PIs and EMIs are in scope if their product meets the CRS financial account test. And the practical test is, can customers hold stored value like an account? If yes, then treat it as in scope for CRS. It's also worth calling out that CRS is a global standard, so you can have account holders anywhere in the world and you'll still need to report on them because CRS is a global automatic exchange of information standard. So for example, if you're a UK EMI, you may need to report a Canadian tax resident with a reportable account to HMRC, and HMRC will handle the onward exchange of that information. So how do you submit CRS? Well, you need to submit it in XML to HMRC via its online reporting service by the 31st of May 2027. And there are 3 sort of key buckets under the data fields needed to be collected, and I'd like to run you through those now. So first up is accounts. So you need to record and report account IDs or references, product types, open and close dates, balances, and reportable income. For individuals, you'll need to record and report their name, address, date of birth, tax self-certificate, and all tax residences. And if they have multiple tax residences, a tax identification number per country or reason if that's unavailable. For corporates, you'll need their entity name, address, tax self-certificate, their entity classification under CRS, plus for controlling persons, you'll need the same details as we've just described for individuals. So what is the checklist for CRS2? How do we get ready? Well, first up, confirm scope. So are your accounts or wallets properly in scope? Do they permit customers to store value? If yes, you'll probably need to report. Step 2, if you haven't done this already, is to fix onboarding. So that ensures that you can capture those tax residences and tax identification numbers from day one. And the third step that you really need to be thinking about is ongoing monitoring. So you'll need to periodically check the tax data and KYC data align. So look for changes in circumstances that might prompt you to recheck the customer's tax information. So for example, has the customer changed their address? Have they changed the country code of their phone number? You'll need to build in some of these checks and triggers to support your ongoing monitoring. And so the message with CRS2 is this report is not due until next year, but the work definitely starts now. And now on to our last snapshot of the session, which is the UK CARF reporting. And this is similar to CRS2. We're very firmly in the data collection year now with reporting to happen next year. And so the whole point with CARF is HMRC wants a standardized report on crypto users and their in-scope transactions. And again, that's so that they can enforce tax compliance and exchange data internationally where they need to. So what is CARF in practice? It's an annual return where crypto asset service providers need to do 3 things. They need to identify reportable users, collect and validate tax residency in TINs, similar to CRS2, and they need to report in-scope crypto transactions to HMRC in that standardized format. And again, the timing is very similar to CRS2. So data requirements start collecting the data from 1st of Jan this year, submit it by 31st of May 2027. Submissions, again, are in XML. You need to use the CARF schema and submit it via HMRC's online reporting service. And so the big question, as always, am I in scope? So the scope test for CARF is based on what you do and who you serve. So you're likely in scope if you're a reporting crypto asset service provider, you're providing crypto asset services to UK tax residents. That's really important because the reporting is triggered by your user's tax residence, not your headquarters, for example. And the type of activity to be reported is really broad. Most types of crypto activity are reportable, so crypto to fiat, crypto to crypto, transfers, and certain in-scope retail payments as well. And there are sort of two key operational considerations worth pointing out with the CARF return. First up is that there is a user notification requirement. So if a user is reportable, you need to notify them that their data will be reported to HMRC and may be shared internationally. You need to do this by 31st of Jan after their first reportable year. Second is, if you haven't already done this and you're a reporting crypto asset service provider, you need to make sure you register by HMRC, with HMRC by the 31st of May 2027 or the 31st of January after your first in-scope report year, whichever is later. And the three types of buckets of data that you need to collect are very similar to CRS2. So you need to report accounts and wallets, so the account ID and reference, or the wallet address and ID. For individuals, it's very similar, again, to CRS, so name, address, date of birth, tax residences, and TINs per country, or valid reason code if you don't have those. For corporates, it's entity name, address, tax resident, and TINs, plus controlling persons, with the same details for individuals. And the transactions are crypto. You need to report the crypto asset type and the annual totals by category. So you need to pull out whether it's crypto to fiat, crypto to crypto, transfers, etc. So how do we get ready for CARF? So the checklist here is, number one, confirm scope and register. Are you an RCASP with UK tax resident users? If so, get registering with HMRC if you haven't done that already. Step two is to think about building out your customer comms. So you'll need to notify reportable users that you're reporting to HMRC and potentially cross-border sharing of their data. Think about which documents and disclosures that you can build this into. And third, if you haven't done this already, fix your onboarding so you can capture this tax residency and TIN data from day one, and clearly tag reportable users in your system and the various transaction types that we just mentioned, so that you can pull those reliably, so you can pull those totals reliably. And that is very quickly the snapshot for the three key reports that we wanted to discuss today. I'm going to hand over to you, Dan.
Thank you, Fiona. That was very insightful. So in terms of getting these reports generated and submitting, Comply First can help. So we're a reporting platform. We are a little different to the traditional Excel to XML template converters that you may or may not be used to. We're a SaaS platform, so we can get rid of that manual data entry on the likes of reg data, and we can automate those reports. We also show you built-in guidance on each cell and validate in real time. We have an FCA integration, so we can actually submit all of these reports via our API, so we can automate the process directly from your systems, directly into the reg data platform. You can also DM us on Slack or Teams or hop on a Zoom call when you want for fast one-to-one support to resolve and validate any errors, even on deadline day. We support a ton of jurisdictions, so you can have a single view of all of your reporting obligations in one place, and our tech team don't need to interpret schemas and build reports from scratch. So to help you with your 2026 reporting roadmap, we're offering to help you generate and submit your first report on us at no cost. And if that sounds interesting, please pop myself or Fiona an email. So before we do the Q&A, I wanted to run a quick poll on, do you want us to reach out to help you with any of these reports that are coming down the line, essentially? So you should now be able to vote. So we'll leave that open and let you vote. And in terms of a bit of the sort of webinar admin, we'll be sending over the slides. So you've got those one-page snapshots that you can share with your teams. And we'll also be sharing the recording of the webinar as well. So thank you for voting. We will go back to the presentation. And so next, we have a few questions in the chat. So we'll go through a few of these. Let me bring them up. So the first question we have, Fiona, is for the safeguarding return, what triggers a notifiable breach in section 9?
Yeah, so it's any notifiable breach under CAS 15. So things like material errors in your records, things like coming close to the expiry of your insurance or guarantee policy 3 months in advance. You need to let the FCA know 3 months in advance. Any of those sort of key requirements that would suggest that you're not fulfilling your safeguarding obligations. So just refer back to CAS 15, and there's a sort of distinct list there of the various notifiable events.
Perfect. There was another question around whether they can automate this monthly return. So I'll take that. Yes, essentially, our platform would enable you to essentially take your data extracts from your system for all of the sort of reconciliation data and auto-populate that into the report. And then we've got the API to submit it directly to the FCA. So that's very quickly that one. Here is another one, Fiona, this time on the CARF. Is there a specific way I should handle users with multiple tax residencies?
Yeah, it's fine if you have users with multiple tax residences. You just need to record all of those tax residences and request a tax identification number for each. And if you don't have a TIN for each one, then you'll need to record a reason why not. But essentially, it's expected. It's fine. Just record it correctly.
Perfect. And then I think there are a few other ones, but we'll do this as the last one. Are non-UK crypto firms going to be considered in scope for CARF?
Yes. So it's not about your location. It's about, are you providing an in-scope crypto transaction or crypto service to UK residents? So yes, potentially you are in scope for CARF as well.
Perfect. I'll hand it back over to you, Fiona, to wrap up.
Yeah, I guess we've got 1 minute left to go. That went extremely fast. I appreciate we ran through each of those snapshots fairly quickly, as we had a lot to cover in 30 minutes. But if you need help with any of these snapshots or you want to discuss further, just pop us an email or a DM and we'll be happy to jump on a call with you. And thank you so much for joining us, and we hope to see you. We hope to see you at another webinar soon. All right, thank you very much, everyone.